Thank you, ladies and gentlemen. I'll say at the beginning, I support the proposition. I blame more Washington than Wall Street for this financial crisis. But I should say at the beginning that I do agree that Wall Streeters, bankers, traders, investors are greedy. Sometimes they are stupid, they are arrogant, they're incompetent, they take too much risk, they take too much leverage, they have overcompensated. All that's true. But we've had the worst financial crisis since the Great Depression, and we have to ask ourselves, are bankers and investors more greedy and more immoral than they were 20 years ago? 20 years ago, Gordon Gekko in Wall Street said that greed is good. I don't think that's changed. We know that there is always greed. Actually, greed in some sense is good. It's one of the drivers of capitalism. But we know that greed has to be controlled by three things: by fear of losses, by the fact that you should not expect it to be bailed out, and by a system of prudential regulation and supervision of the financial system, because financial markets without rules and institutions are like the law of the jungle. And that, to me, it's a failure. I expect Wall Street to be greedy, but I expect a good policymaker trying to control that behavior, and that did not happen in many dimensions. The Fed and Greenspan, after the last tech bubble went bust, cut interest rates almost to zero, and created this asset bubble, kept interest rates too low for too long. It was not at that time. People talked about the Greenspan put in financial market. Was it the expectation whenever trouble occurs, Greenspan is going to ease things and get you out of your losses and problems? It happened after the 1987 stock market crash and the SNL crisis easing. Then in the 90s, we had the tech bubble. Greenspan warned about irrational exuberance and did nothing about it. And after the tech bubble went bust, it cut interest rates from 6.5% down to 1%, and it created the latest bubble. So he has been a creator of serial bubbles one after the other, and when people expect to be bailed out, then they behave accordingly. That's the Greenspan truth. We created a system in which people expect that the gains are going to be privatized and the losses are going to be socialized. This is welfare state for the rich, for the well-connected, and for Wall Street. That's what happened. That's public policy. The attitude of the Fed regarding asset bubble was, you don't do anything on the way up. That was the official view of Greenspan, Don Cohn, and Ben Bernanke. And when the asset bubble collapses, to avoid the collateral damage to a real economy, you ease aggressively. Again, that's a biased behavior that creates more and more bubbles. We're running out of the bubbles, actually, to create, with the real estate bubble, the tech bubble, the hedge fund bubble, the private equity bubble, even the commodity bubble, the art bubble. We're running out of bubble to create, but we're easing again down to zero. So what's going to happen this time around? As Paul has pointed out, the job of the Fed is to take away the punch bowl when the party gets going. But unfortunately, not only the Fed did not take away the punch bowl, it added vodka, whiskey, gin, and every toxic stuff to it. And it made the bubble even bigger. Take the role of the Fed and the regulators with subprime mortgages. Greenspan was the biggest cheerleader of this kind of financial innovation. Zero down payment, no verification of income, assets, and jobs. They call them ninja loans or liar loans. Interest rate only mortgages, negative amortization, teaser rates, all this toxic stuff was subprime, near prime, prime. The Fed and Greenspan actively said was the best thing that could have happened to mortgages. Free market, they could control it. They had the law, the power to do it, they didn't do it. Think about our public policy towards housing and mortgages. The Community Reinvestment Act, creation of Fannie and Freddie subsidized housing, the 20 ways in which we have subsidized through tax policy, interest deductibility of mortgages, the worst and the most unproductive form of investment in housing. Big McMansion can give you utility but doesn't increase the stock of capital in a real way or productivity of capital and labor like physical capital does. We have subsidized housing in 20 different ways. That has led to the bubble as well. There was an ideology for the last decade in Washington that was critical to this financial crisis. It was an ideology of laissez-faire, Wild West, unregulated capitalism. The basis of this ideology were the idea that banks and financial institutions will self-regulate. And as we know, self-regulation means no regulation. It was the ideology of relying on market discipline. And we know that when there is irrational exuberance, there is zero market discipline. There was an ideology and policies of relying on internal risk management model. And as was pointed out, Chuck Prince said, when the music is playing, you got to stand up and dance. Nobody listens in good times to the risk managers. They're the party poopers. Only the risk takers have the advantage in the banks, and therefore relying on internal risk management doesn't work. Was relying on rating agencies that had massive conflicts of interest because of being paid by those that were supposed to be rating. And these rating agencies had the quasi-governmental role, that monopoly, oligopoly power, and power to decide whose asset you can buy or not buy. That was policy that led them to have that power and those kind of distortion. So every element of our regulatory system has failed. This Basel Accord that relied on this principle has failed even before it was implemented, relying on principle rather than rules, relying on light touch rather than tough rules. Light touch means no touch at all. The ideology of Greenspan was every financial innovation is great, markets self-regulate, shareholders are going to be able to control the behavior of bankers and so on. This was the belief in deregulation. Elements of it, actions were taken. The repeal of Glass-Steagall that separated investment banking from commercial banking. Now we let essentially use deposit insurance and deposits to do 30 times leverage prop trading. That's what was allowed. Essentially deregulation of credit derivatives and derivatives over the counter with systemic risk. Things of that sort were going on. The SEC deciding the leverage ratios 30-1 was okay. Those were the policies that led them to those excesses. There is greed, is up to public policy to make sure the greed is controlled, because otherwise, if you don't have rules, institutions, and balance, and prudential regulation supervision, is the law of the jungle. And unfortunately, the last element of it was regulatory capture, was an ideology in which the government, those who were in power, had taken over and controlled by lobbyists, by those who were pushing for this kind of deregulation. So it was a massive failure of public policy. Thank you.